Welcome everybody. I just want to say thank you for joining us for our 2023 Housing Outlook. As we come here today, I'm joined by Melissa Swift, who is our in-house real estate expert, and by Tim Harrison at the HLC team. As we look at the market for housing, this has basically been one of the big questions that we have from clients all the time. From a couple of different areas is kind of like, is the market going to crash? I don't care how many YouTube videos you pull up, it seems like that's the clickbait or the headlines that the market's crashing, things are going to be 2008 all over again. And I really wanted just to kind of get some real data out there and some information to our clients and to people so that they could see that really that's probably not the case. So as we turn to Melissa, what do you see as kind of the trend or the outlook for 2023 when it comes to the housing market?
Yeah, so a few trends that I've been seeing is one, houses prices are softening. I agree with you. I don't think there's going to be a huge crash happening. I do think a housing correction is more likely. I think by the end of 2023 could be down maybe 7 to 8% on home prices. But basically what happened, right, is inflation went crazy and you just had people with less disposable income, less money in their savings, and just trying to spend less overall. So there's less competition in the market, so that kind of softens the home prices. And we've seen that with across the country with median home prices came down about 4% in December from the month prior. And then in California it was more like 3%, bringing the median home price to about $680,000. So that's one of the trends that I've been seeing.
So a little bit of softening, but not necessarily that the market's crashing at this point in time.
Yeah.
As far as, do you see that there's a deviation in geographic areas, or how do you see that come?
Yeah, something interesting that I saw and was looking at was new home sales across the country. And this had actually grown for 3 months consecutively to about over 600,000 homes per month across the country. But when you kind of zoomed in and looked more closely, this growth was really happening in the South and the Midwest, but it wasn't really growing in the West and the Northeast. So I think that could be an indication of where people are maybe migrating to, maybe where jobs are moving to, builders may be building more there. So that's something else that I've seen that was pretty interesting.
Very interesting. Tim, how about in the mortgage side? What do you guys see as the kind of trend that's happening in 2023?
So what's interesting is in 2022, you did see that slowdown. And I mean, demand was way down. Prices didn't fall like you would think for the amount of decrease in demand. It went to like a third of normal. And of course, we had crazy 2020-21. We've had the prices shot up. We had super low interest rates, made houses so affordable. And then you started creeping up to 7%. And of course, the demand has sort of died. But one of the things you're seeing is that you ask about the 2008 crash and all that stuff. In my opinion, unless we hit a really bad recession, that's not going to happen. And here's why. All my clients are in the 2s and 3s. 77% are under 3.5% or something like that. It's crazy. So their house is so affordable now, if they were going to go to sell and buy something else, they're potentially going to double their interest rate. So it's keeping the inventory really tight. But what we're seeing is, look, as prices go down a little bit and interest rates go down a little bit, that demand is coming back, and it's come back real strong in 2023, the beginning of this year. You know, we were sitting there like in December going, are we going to get a call? Because demand was so low, and then rates started trickling down. And then all of a sudden, boom, we're starting to see people going, especially millennials and first-time homebuyers are going, okay, well, if prices aren't going to crash, my rate's coming down, and I at least have a chance to get a property. Because we know in 2020 and 2021, there's like 10 offers on every property. They're getting bid up $100,000. These people couldn't even get an opportunity to buy a house if they had lower down than cash. So now they're seeing opportunities to buy, and they're going, you know what? I'm gonna go ahead and marry the house and date the rate, because they know they're gonna refinance.
Right.
I mean, I bought my first house. I don't want to age myself next to Melissa, but I bought my first house in 1988 at 10 5/8.
Right.
You know, I'm now in a 2 and 2.5% range. Am I going anywhere? Not a chance. So I think mortgage rates are going to start selling down. You saw the Fed raise rate only a quarter.
Right.
That's a sign that they think they're easing. Their inflation crushing is working.
Yeah.
And when the long-term market starts to see that confidence that inflation isn't going to ruin their return, they're going to start buying those longer-term bonds. In fact, we had a nice improvement in our rates yesterday, even though the short-term rate went up because of that confidence the long-term bond holders are getting.
Yeah. That's exactly right, and that's actually one of the things that Tim brings up. That if you look at the yield curve, long-term rates are definitely coming down over the last couple of months. Short-term rates have been popping up still slightly because of the Fed pushing them higher, but the market, which basically controls longer-term rates, are pushing those rates lower. One of the things that I have heard is that after the holidays, mortgage, or basically house activity has been coming up quite rapidly.
For sure.
So,
like, I see a glimmer of hope. I mean, it was, again, I'm running a team, and you're dealing with paying everybody, but the volume was just so down at 7%. I mean, and inflation on short-term, gas and all that kind of stuff, groceries and everything else, it pinches the consumer. They're like, I can't buy now. But now all that's starting to settle a little bit down. They're seeing the interest rates come down, and now they're like, yeah, I've been sitting around forever waiting for it to crash, and it's not crashing. Again, too many people have a low rate. I think it was a Wall Street Journal article that said, people are handcuffed to their house now.
Right.
I mean, even if I'm going to trade down from an expensive house and go buy something else, if I don't pay cash for that new house when I'm trading down, then I still have to go get a mortgage. And if I'm doubling the mortgage rate
right.
from my 3%, then I might as well stay in the big house.
Well, that's one of the things that I've been hearing a lot of. Melissa's brought up the term, they're married to a mortgage and not to necessarily the house. And
you're
so
right.
That's kept a lot of houses from coming on as inventory. So once again, this has been a supply chain or inventory issue.
Yeah.
And
all the supply chain on everything else is getting fixed, but not housing, right?
yeah, builders have been slowing down. I know that in the recent study from the Nashville area, permit-wise, for the last 2 months, they have only averaged about 700 permits, where last year, the same time, they were about 1,300 to 1,400 permits. So a substantial discount in the number of permits for new homes coming on the market, while simultaneously, people are just not putting houses on the market. So once again, if you were going to have a crash in the market, you would have this, mass inventory that would come on, and people would be undercutting one another, and we're just not seeing that at this point
in fact,
in time.
There's a guy named Steve Thomas that does like data here in Los Angeles County, Orange County, San Francisco County. He's like a data statistician on this kind of stuff. And what he saw was like demand really going down, but inventory still wasn't there. And now he's seeing there's a surge in demand at the beginning of the year with the lower rates. And we'll see, right? Because most of the inventory starts coming in January, February, March kind of deal. But we're not seeing that surge in inventory for the same reasons. Again, builders don't want to build because they got crushed in 2008, 9, 10. So they're super nervous to get out there and ahead of their, themselves on their skis and have that, fall off a cliff kind of thing again.
Right.
So the inventory is the biggest problem, and there's still enough people that want to buy. And again, I'm in the right room for you to understand this, but there's still a lot of money out there.
Right.
So you see a lot of people that have money helping their kids, and they don't want to move out of state, and so they're going to help their kids buy in the local area that they're in or whatnot. And that's like a trend I see.
Yeah.
Because it is hard for most people to save when you're thinking about trying to save when there was higher inflation,
Right.
higher gas prices, all this other stuff for the normal person, right? So we've definitely seen though that change in the market. I really think like if we have a soft landing, which it's kind of feeling like we might. From what we're reading, that unless we see a bunch of layoffs and things like that, and people are forced to sell their homes, and even then, look at what the mortgage people did last time. They worked with these people to try to keep them in the home, and added money to the back. That inventory that happened at the very beginning last time may not happen this time. We don't have stupid loans out there that people had to run away from because they jumped up ridiculous. Everybody that qualified, they qualified a lot, and rents are high.
That's what I was going to ask you about. Is have you seen a change in the requirement for a mortgage over the course of the last couple of years or so? Meaning, have they started to reduce the fact that you can come in with no money down, or what do you see there? Or you don't have to show that you're having earnings and so forth?
So after the 2008, 9, 10 thing, right? There was just loans that were stupid. Like if you could fog a mirror, you got a mortgage. And there's certain lenders and investors out there, the ones where we watched like go out of business very quickly, the subprime and even the Alt A product, which was not quite perfect, just go away. Like that's where it just went away. Mortgages since then have been pretty tight, meaning you really have to qualify. You have to show your income, even on the stated income, which a lot of self-employed borrowers used. they changed it to where they would go off a percentage of your deposits on bank statements, either business or personal.
Right.
So there is no just, hey, write down your income, what do you make, right? You qualify. And most, unless you're a VA, I mean, you really aren't seeing zero down programs at all. But you could still get in with the Fannie Mae with 3% down and 5% down, FHA at 3.5% down. So there's still low down product available, but quite frankly, the underwriting is pretty well scrutinized. The appraisals are scrutinized. So when we look at it, I think now there's like more equity than ever in the United States, meaning people have a lot of equity in their homes.
Right.
Not likely to see that crash. Because think about 2020, 2021. People that are buying houses were paying cash or putting a ton of money down just to get their offer accepted.
Yeah.
So the ones who bought houses recently, they already have a lot of equity, or they put little down and their prices already jumped up during that time.
Yeah.
Right.
So
That's
if things
where,
get
yeah.
tight, they can just sell and instead of going under.
Right, which means they probably don't have to reduce their price that fast unless there's a major recession, and there's no sign of that with where the jobs are right now, right? I mean,
Yeah. Well, that basically is, what I've been looking at is take it from the other side where we do a lot of we do a lot of analytics on banks, and bank balance sheets as far as banks' exposure to bad loans and stuff haven't gone up at all. For the most part, it's people are saving a ton of money. They are putting money down. They've got a lot of equity in the homes, and we just don't see that there is the situation that happened in 2008 where you really had this flood of bad loans that were going to come on the market. We just don't see that happening. And even if it did, maybe it would just bring the housing market back to more normal from a very, very tight market. So once again, we're not saying that there's going to be these huge declines. It will be something that I think will be a bit sporadic, meaning I think places like Las Vegas, maybe Phoenix, Miami, where they had a bit of overbuilding for that particular geographic area, could see a bit more softening than if you went somewhere like a Nashville or a Huntsville or a Charleston, where they just simply don't have enough homes.
Yeah, there's growth. And one of the other interesting things too is we have a recession. We know the Fed lowers rates to try to motivate everybody to start spending money again. And in the last 5 recessions, only 2 of them did we actually have prices of houses go down.
Right.
So if you look at the tight inventory, people hang on to their houses, even if we hit a recession, unless it's major, you still have an inventory problem in most areas.
Yeah.
So it's gonna be really interesting. I've been doing for this for 30 years, and this is the first time where I'm kind of like, whoa, I mean, this is really different because of those pandemic interest rates that people refinance to. They're just, people are just so low on their mortgage payments for the most part. And there's still a lot, the millennials, like one of the biggest buying groups out there.
Right.
And a lot of them have been sitting on the side at some point in time. They're hitting that point, like we're getting married and wanting houses and stuff later, but they're really hitting now.
Yeah.
So again, inventory is going to be tight in my opinion.
Right. So anyhow, as we kind of wrap things up and we look at 2023, probably we'll see some softening in the housing market, a little bit more depending on the geographic area. But overall, we don't see a housing crash. We see that inventories will still be tight, and especially in a lot of areas. And that as the year goes by, most definitely we feel that we're probably at the top of our interest rate cycle, and we'll start to see those gradually go down over the course of the next 12 to 18 months, which once again, that just puts a little bit more demand in the housing market as rates look better and better. Just as I kind of finish up, our thoughts are that we'll see rates, they've been somewhere around 6.5, I think right now. Is that?
Yeah, coming down towards 6, and I think, well, you say what you think, and I'll say what I think.
That's exactly it. I think we end up probably in the next 12 months or so, probably somewhere around 5, maybe as low as 4.5 over the next 18 months.
I like your numbers better than mine. I was
Okay.
thinking like 5 to 5.5.
Okay.
But one of the things I want to mention to those millennials and some probably a lot of your clients' kids and stuff like that is now is a good time because with the inventory available, there isn't the same crazy demand there was, and that you can get a house. You could potentially, if you don't have that much money, negotiate for closing costs. Those are some of the things that have come back. Again, the regular market that was unheard of before. You don't have to be a cash buyer. So I think it is a good time to marry the house and date the rate. Those are the new buyers, right? And the others are, keeping the rate and staying in the house that they don't want to,
Yeah.
They want a divorce, but they can't.
Yeah, of course not.
I really appreciate your guys' information. If anybody else has any other questions, please do not hesitate to call myself or Melissa at our offices or Tim at his office. We'll have his information down below. Thank you.